Welcome, everybody. Today I have David Barnett, author, speaker, educator, seminar host, podcaster, and buys and sells businesses process coach in the mid-market. That's quite a mouthful, David. Welcome.
Well, thank you. It's taken quite a bit of effort to tack all those things together, but I enjoy them all very much.
Well, you must have a lot of experience to be able to complete all of that. And I do encourage people to go across to the smallbusinessanddealmakingpodcast.com, where you put in some amazing videos on how-tos and the situation in the world and what's happening with this type of industry. So I encourage people to go across smallbusinessanddealmakingpodcast.com. Excellent.
Yeah, that leads over to my YouTube channel. And so if you just look up David Barnett, small business, you'll find me easily on all those platforms as well.
Okay, perfect. So David, you do something rather unusual, and that is you're into valuations of equipment as well, of businesses with large quantities of equipment. You can buy a business, but if you don't buy the right one, it's not going to work out for you. So can we have a bit of a chat about your equipment side of things there and tell me what you do there, please?
Yeah. So in addition to being a consultant and helping people buy and sell companies and doing business valuations in the main street and lower mid-market space, what we also are is certified machinery and equipment appraisers. And the reason why that is important is because when people sometimes are seeking financing to acquire a business, sometimes that financing will be based upon the collateral within the business. And so we get engaged by people actually who don't know us. They're referred to us by lenders sometimes when they're making a loan application to say, hey, we need to have a certified appraisal of the equipment here in the business in order to be able to proceed with this loan. And so we do machinery and equipment evaluations, and we've done some pretty interesting projects, from fast food restaurants where we're evaluating, kitchen equipment and the furnishings in the dining room and things of this nature, all the way up to large construction companies where they do road building and railroad contract work, where they have literally hundreds of pieces of equipment in the form of trucks and other big pieces of machinery that we've evaluated. So the projects can be quite expedient, taking an afternoon's visit and then a couple of days to do research and put the report together, all the way up to projects that take several weeks to complete.
And a mistake that people often make, newbies make, this type of company, when they look at it, they see, we've got a large amount of cash, working capital in there. And, that'll be nice to suck on out. I'm going to get paid $2 million a year based on this working capital and this turnover. But what they don't realize is that there's that constant, you have to keep on buying equipment right the way through. There's a constant turnover of equipment. Inventory, yes. That isn't your business. Yes, on the inventory side.
So when we're looking at evaluating a business as a going concern, what we're looking at is the cash flow of the business. And many people are very familiar with the idea of normalizing an income statement. So if there's some expense on the income statement of a personal nature to the owner, people will add that back, realizing it's not actually a business expense. For example, people will add back depreciation, amortization, interest in order to get to EBITDA. They'll add back the owner's salary to get to a seller's discretionary earnings level of cash flow if they're looking at a smaller business. But what very few people understand is that when you're doing a business evaluation, you also need to normalize the balance sheet. In fact, a lot of people kind of ignore the balance sheet. But the balance sheet's very important because this is where you find out about things such as, what kind of working capital is required in the business. Now, if a business has been successful and profitable for a long period of time, so if you're looking at a company that's been earning good profits for 20 years, what normally you see when you look at their balance sheet is you see an overcapitalized balance sheet, because business owners tend to bring their, I call it a homeowner mentality, into their business, where they don't really like to have debt. And so they'll want to pay down debt, and they end up with a balance sheet that might have very little in the way of long-term debt. They might have things like receivables and inventories that they're largely financing with their own cash. When we're looking at companies like this, what we have to do is we have to analyze what would a normal balance sheet look like for somebody who is taking full advantage of operating capital financing that might be available. So I like to use the example of a lumber yard or a building supply yard, where you could have a company with earnings of a couple $100,000 a year, and maybe these businesses sell for 3 times earnings or 2.5 times earnings. So that would imply a valuation on the business of $500,000 to $600,000, somewhere in there. And so this business owner ponders this and says, wait a minute, I've got $1 million worth of inventory in this business. How can the business only be worth $500,000 or $600,000? And so this is where we have to start looking at what is the normal financing package available for the inventory of this nature in this industry. Something like a building supply company is going to have what we call a fungible inventory. This means that the sticks of lumber or the cinder blocks or the bricks, like all this kind of thing that they have in the yard, it's identical to what every other retailer is selling in that industry. And these things don't go bad with time. And so what that means is that you should be able to have a greater degree of financing attached to those pieces of inventory than something like a ladies' dress shop or a produce store, for example. So if we look at that inventory and we say normally a lender might give us a line of credit to support 3/4 of this inventory, it means that normally we should have a line of credit of $750,000 for that $1 million inventory. And if normally, because of our revolving purchases with suppliers, we're going to have an outstanding accounts payable every month of about $200,000. What it means is that of that $1 million of inventory, $950,000 is normally carried through a line of credit and the payables. That leaves $50,000, which needs to actually be supported by the equity of the owner. And that $50,000 is what we call the net normal position in working capital. And this is a concept that is pretty well understood amongst people that work in sort of the larger business space. It rarely trickles down to people that are working on Main Street or lower mid-market businesses. And so there's often a lot of confusion. You'll see businesses put up for sale where they just don't know how to deal with it. So what they'll do is they'll multiply the cash flow and then they'll just say plus inventory. And so they'll say, my business is worth 500,000 plus $1 million, right? And it's because there's a lack of understanding in the concepts that go into coming up with the actual calculation of what the value of this business might be. And so, through the normal back and forth of negotiations, some of these businesses end up being sold. Sometimes the buyer will be able to acquire the business and they'll figure out how they might be able to put some financing in place. One of the keys when you are looking at a company that should have a large amount of normal financing to support inventory is that you actually have to make sure you take the carrying costs of that finance package into account on your normalized income statement. So we see this often with businesses that might participate with some kind of floor plan financing, like appliance showroom type businesses or furniture dealers, car dealers, tractor dealers, these types of people, where if they're paying interest on the floor plan, we then want to include it on the income statement, even though the normal rules of normalization might imply that we add back interest. We still want to record that as one of the normal costs that has to be covered by someone who's going to operate a business with that kind of scenario.
Wow, that was a lot. However, I think you put it pretty simply. It was
I try. That's what I try to do.
And that's why I say go and look at your podcast, because the videos in there are very simple to understand. So thank you for that. I noticed you said we a few times there. Just to clarify, you've got a team behind you as well. It's not just you doing all of this stuff. It's your team.
Yeah, we're a team of 5. So there's myself and we have a receptionist and executive assistant for myself. We have a social media person, and there's 2 other analysts on our team as well. So when we work with people to help them on a project to buy or sell a business, it is the analysis team, which is the 3 of us, and we really do work on things together. So even though one person will lead up a particular project, we have a couple of standing meetings each week where the 3 of us look at each file, give our input, and try to learn from each other. We all come from a different sort of analysis background, and we're all learning from each other every day.
I don't think I've commented on that enough in my podcast, is that everyone that I talk to all has a team around them. It's not just the individual. You've got to have that team so that you can cover in the gaps and be more productive as well.
Even people that are involved in M&A advisory who are solo practitioners, what I find is that they will build those teams informally. Maybe it's through associations that they might be a member of, where they'll meet colleagues and sort of create relationships where they can call and talk with each other on the telephone to bounce ideas off each other. But you're right, it is very difficult to be standing alone and try to make sure that you've thought of everything. A lot of the work we do, we will purposefully ask ridiculous questions. I took an innovation class once in university, And it was based upon a book. I forget the name of the book or the author, but the premise was that innovation came from trying to figure out the answers to sort of ridiculous questions. And I'll give you an example. Back in the 1970s, an engineer apparently at General Motors asked their colleagues, how would we build a car with square wheels? And everyone kind of thought, well, you can't, but if we had to, how would we do that? And they realized very quickly that they would have to break the axle and have each wheel attached to its own independent piece of axle. And it was from that exercise that we got independent suspension, which every vehicle on the planet now has. And so the ridiculous question led to people thinking about problems in new ways, which then led to an actual applicable solution that that benefits everyone.
It brings something up here. I was doing a job at the University of Melbourne, prestigious university here in Australia, and I was sitting across the table, the dining table, from my son. He was about 5, 6 maybe, and I bumped the table and he felt it on the other side. Well, we got into discussions on how that occurred, and it went through, and eventually we made it into dark matter. I said, Christopher, I said, I'm sorry. I said, I've only got university physics. You've exceeded my capabilities. I'm sorry. So one of the questions that I've always tried to extend my son's thinking capabilities, and he's now 27, by the way. We tried to figure out once, how would you communicate from Earth to Venus? And how can you do it in real time?
And what was your solution?
Well, nothing was off the table. And I showed my son, I said, well, maybe, this was, sorry for the background, folded the piece of paper. I said, if we shorten the distance and fold the space, that would allow it to happen. We also spoke of, my son came up with telepathy. Okay, that's fair.
Yeah.
Yeah, fair enough. So anyway, on the way to work the next day, I walked through the physics department of Melbourne University, and I bumped into a professor there. And I asked him the question, and he said, oh, you can't. He said, it's impossible. At that stage, I concluded that I would never, ever, ever want to do physics at Melbourne University, because if the professors were that narrow-minded and that short-sighted, whereas I can now tell you that only about a year ago, the Japanese, and how I learnt this, by the way, is a guy called Jim Keyes. He's the ex-CEO of Blockbuster and the ex-CEO of 7-Eleven. I was sitting having a chat with him in a booth at a cafe last year, and we were just chatting. Now, when a billionaire wants to talk, you shut up and you just listen and you do whatever, take on whatever conversation they want to take on. Well, this same conversation came up, and he was explaining to me that they created a wormhole in Japan, and you can shine a laser through it, which gives you instant communications. And now with quantum entanglement and being able to have a proton in two places at once, this physicist was not innovative at all. This guy at Melbourne University was not innovative at all. My 5-year-old son was smarter than him.
I'm not up to date on all of these developments that you're talking about, but I can just imagine, with the way things are progressing, one day cell phone company stock just won't be worth anything. We'll all have one of those little Star Trek communicators on our chest or something, right? I mean, the future's heading towards us at full speed.
Yeah, probably. But anyway, let's talk about your door back there. Buying versus in a small business. This is a conversation that I had with my godson recently when we were moving house. And I said to him, so you're going into business. I said, what sort of business would you buy? Or would you start? And we had a bit of a chat about that. I said, okay. I said, the very, very first rule is that you never buy a company that's less than 5 years old. He said, why? I said, well, most companies, a large majority of them, fail before they're 5. So I said, if it's made it to 5 years, I said, it's probably done something right. He said, what if it's got a really bad reputation? I said, well, if it's still at 5 years, I said, it's still done something right. So I said, you can have to fix the reputation. What's your view on that?
That is the cover of a book that just came out in the fall. So it's been out for less than a year. And it's really a book for people that are considering getting into business for the first time. And so I basically demonstrate sort of the pros and cons of both paths. And I show people that it's easy to come to the conclusion that buying a business is less risky or safer than starting one, because when people are starting a business, they're always worried about the customer acquisition risk. What if I can't get enough customers quickly enough to reach my break even point? And it's an easy risk to understand if you're thinking about starting a business. And of course, if you buy an existing business that is profitable, you shouldn't have that risk. You've already got customers, right? But here's the issue is that if you pay too high a price for that business and you end up with a lot of financing, you become very leveraged, you expose yourself to finance risk. And now you're in a position where even though you have customers, if you lose any of them, to even a minor amount of customers and your sales start to dip down, even a few percentage points, it can have a much larger impact on profitability and then threaten your ability to service the debt. So you actually end up in the same position as if the startup person, because now you're still struggling to make sure you have a certain level of clientele or customers. And when you start a business, your risk of loss is typically limited to the amount of money that you put in initially and maybe some revolving credit you have access to, some credit cards, lines of credit, etc. And if things don't go well, you'll have to deal with that. But if you buy a business and borrow money from lenders, I mean, you could end up several hundred thousand or millions of dollars in debt to do this transaction. And then if it fails, you're in a much worse position, of course. And so I try to show both sides of the coin and really highlight the fact that if you overpay, you can get into trouble. And the reason why I think it's an important message is that there's been such an explosion, particularly in online content, around this idea of buying businesses. And I hear people telling stories of acquisitions that they've done, and people will describe the business. They'll talk about the numbers a little bit, their sales, their cash flow, and they'll talk about their transaction and what multiple of sellers' discretionary earnings, for example, they paid. And I'll listen to this podcast on my morning walk and I'll realize, this person won't know for another 24 months that they've overpaid for the business and they're in trouble. And right now, they think they're very smart because they put this deal together and they've got the business. And this is one of the issues that we face in this space is that people become very focused upon doing the deal and how can I get the deal done and how can I get everything signed and transferred over. But I like to talk about what I call the day two problem, which is once you've done the deal, you then have to operate the business successfully and it has to cash flow and it has to service its debts. You've got to be able to pay taxes. You have to be able to replace capital equipment. We started the conversation by talking about equipment. Most of the time, people are buying businesses as a function of either EBITDA or SDE cash flow, which does not account for the wearing out of stuff. That's what accountants call depreciation. It's counting for the wearing out of
And
equipment.
most of the time, they're not even qualified to know what that is. They hear the words and they just don't understand it.
That's right. They're told by someone like a business broker, you don't need to account for depreciation because it's a non-cash expense. And a company that buys a truck, for example, that's expensive. And yes, over the course of many years, they're going to depreciate that truck and they're not paying anything at that time. But when they bought the truck, it certainly had a cost. It costs a lot of cash to acquire. So when we're working with buyers, we're very careful to what we will add back depreciation, but then we create a CapEx allowance because I don't necessarily think that depreciation in small businesses is even calculated in a way that we can rely upon as business buyers. I'll give you an example. If you have a business with one delivery truck, that's a large piece of equipment. It's very expensive, but it can drive around for 8 or 10 years, right? And in the first few years, it's going to be depreciated quite a bit if we're using a 30% declining balance methodology. But towards the end of its life, the depreciation charge is going to be quite low. And so if you bought this business in year 7 of the truck's ownership and you relied upon the depreciation number to somehow account for the value of the truck wearing out, you'd actually be using a number that's probably way too low. And if you bought the business in the second year, you'd be looking at a number that's probably too high. So what I like to do with a business in this scenario where you've got sort of one major piece of capital equipment is I'll say to my client, let's go figure out how much it would cost you to lease a truck like this brand new. And a leasing arrangement gives you an even monthly payment over the course of the life of the asset. And so we'll use that lease payment as a CapEx proxy. And so we'll use that as our budget. We'll say, out of this cash flow, let's assume that at some point in the next few years, you're going to have to replace that truck. You're going to lease a new one. And this is the lease payment that you're going to have to pay every month out of your cash flow. And so we'll deduct that out of the EBITDA or SDE cash flow to kind of be the stand-in for the CapEx replacement that's going to be required in the business.
And when you buy a business with land, with property associated with it, do you split the property and keep the business into two separate things and do that exact same thing of the leasing of the truck, leasing of the property and the building as well?
So it depends on this simple question. Is the business dependent upon certain special kind of real estate? So if you're talking about a mini storage, a motel, a special care home, there are certain businesses that in fact are the real estate, right?
Or Docklands.
And then you,
Yeah.
right?
Okay.
There's all kinds, right?
Mm.
And so in that case, you have to keep them combined, and you have to use a different set of multipliers that are attuned to those industries, given the investment in the large capital investment in the property. Then we have businesses that really are not reliant upon their property. So a business that needs some showroom and warehouse space, this kind of business can move around to different places. They can lease, they can own, it doesn't really matter. And so if they do happen to own their property, we want to separate them. So we're going to remove the building from the balance sheet. We're going to add a fair market rent to the income statement so that we can look at the activity of the business in isolation from what's happening with the real estate. There's a third category, and that is when all the real estate is a place to park your very expensive machine. And so an extreme example of this would be like an oil refinery. And so it's not that the land necessarily holds a lot of value. It's the equipment on the land that's holding the value. The industrial land like that is often quite cheap. And so in that scenario, again, I keep it all together because really that land can't be valued like real estate or property, comparing to other real estate or pieces of property that may be for sale in the market, because it typically is just a place where some very specialized piece of gear or equipment has been placed. Some other examples of this would be like a really isolated thing. So in my neck of the woods, we have a lot of fish processing plants that are located in very isolated coastal communities. And if that plant closed, there isn't anyone who's moving in there with any other kind of business because they're an hour and a half off the beaten track, down a twisty, windy road. And so really that piece of property and the way they've developed that real estate is specifically for that business. And it's all got to be taken into account together with the business.
Well, what I get out of that, David, is though someone like myself can look at a balance sheet, look at the profit and loss, get a basic understanding of what the feel for the business, when you come right down to it, you're better to actually go and get a professional valuation done. That way you're more secure in your decisions.
Yeah. I mean, the way that we kind of position our services is kind of like insurance, so if people are going to be spending hundreds of thousands or millions of dollars on a transaction, does it make sense to spend a few $1,000s with somebody who literally works on this stuff all day, all week long? And we typically work on 3 or 4 new files every week. So we've got a good volume of activity going on. And for most, sort of Main Street, lower middle market businesses, we've seen the business you're looking at before. We get a constant flow of, sort of name your common business type, and we've probably done 50 of them. And so we can move through the file very quickly and know what to look for. What are the key things that might be specific to that scenario? And I'll give you 2 fun examples. So tutoring businesses. So there's a couple of big names in the world of tutoring. And one of the things that often happens with tutoring businesses is that parents go in, maybe because the child's having trouble in school, and they'll sit down and they'll show the different offerings to the parents. And then the parents will be sold a prepaid package of lessons.
Yep.
So it might be 8-month program, for example. Now, the way that should be accounted for, Craig, is that they should put that into their books, not as a sale, but as a deferred revenue, right? They haven't earned the money yet. And then each month that goes by, as they deliver the lessons, they should be moving money from deferred revenue over to sales. Most small businesses, though, where mom and pop are doing the bookkeeping at night after the close of business, they're not doing this correctly. And so what they'll do is they'll just put it in as a sale. And so when you're looking at a business like that, you have to understand that there could be this unknown liability of deferred revenue. And really, as a buyer, this needs to be accounted for in the transaction. Otherwise, you end up taking over a business and you have to deliver all this education to the children and you're not getting paid for it. Right.
Yeah.
So that's an example where someone from the outside of that industry wouldn't even know to look at that. Another example that I'll give you will be, for example, bridal salons. So I can tell you that on many of the balance sheets of bridal salons, you will find inventory. And if the bridal salon's been around for a long time, you will find a lot of inventory. And this is typically what happens is they will buy these sample dresses, wedding dresses, they'll bring them into the shop. Ladies will come in for fittings, they'll try on different dresses, and these, testers or sales aides, as I call them, they're not actually sold. What'll happen is the lady will try it on. They'll use, various clamps and things to hold it tight to her. And if she says, yes, this is the one, they'll measure her and then they'll have a custom ordered dress made for her and it'll be delivered. And so then at the end of the season, what they'll do is they'll do a sale and try to sell these sample dresses that they still have. And maybe they'll sell some of them. And then the balance of them, they record as this inventory. But here's the thing. When you think about inventory in a business, I think of a grocery store or a hardware store. And if you walk into the hardware store, they've got some hammers on the shelf in their inventory. And what inventory is buying stuff that goes on display that customers pick up and take away and purchase that then is replenished again, right? That's what inventory is. But that's not what's happening in the bridal salon. What's happening in the bridal salon is these samples are being brought in not so they can be sold, but so they can be used to sell the actual dresses that get sold. So in fact, they're not inventory at all. They are strictly a sales expense. These are sales aids that are being used to try to sell the dresses, which are the true product, which are being custom cut and measured, right? And so when the bridal salon brings in the sales samples, they should be recorded as an expense. We spent money on these samples to try to then be able to sell more dresses. At the end of the season, if they are successful in selling some of these dresses, then that should just be recorded as an offset to this expense. But they should just be expensed. And that's not what they do typically. And so if you end up with a shop that has 8 or 10 years of operation and they've amassed this inventory of $400,000 in sample dresses, which are no longer current and really can't be sold, what it really means is that that inventory represents expenses which we now have trouble matching to the right periods of time in the past. The financial statements now are overstated for this business, and it looks more profitable than it really is because they've literally turned an expense into an asset. There's a famous company that learned how to do that, I think, in Texas. Enron, isn't that what the Enron scandal was? Turning expenses into assets. But this is the kind of thing that we see. And when we see it in one place and learn to recognize it, what this is an example of someone, even with a bookkeeper or accountant, not really understanding the fundamentals of the business and knowing how to capture and record the activity of the business accurately in the financial statements. And so when we see these kinds of theoretical problems or business model understanding problems in one place, all of a sudden we start to spot them in other places. And that's more of the value that we bring to the table. It's just that we've seen this stuff before.
There's a gentleman, a mentor of mine, JT Fox, and he makes the comment, how people do one thing is how they do everything. So yes, that I totally understand that. Okay, so we should think about winding this up, David. I would really love a link to your buying versus starting small businesses. So is that on Amazon?
It is, yeah. It's available on Amazon as a Kindle book, and it's also as an audio book too. And you can get it in paperback as well from any of the Amazon stores around the world.
And valuations. It's not an accounting function. It's an assessment. Would that be fair?
So the two professions that deal with numbers are finance and accounting. And the way that I like to describe them to people is that accountants are kind of historians. Their job is to make sure that the activities are accurately recorded. And they are also experts at understanding tax code and tax filings and all of the rules regarding tax to make sure you're compliant with government rules about what you're supposed to pay. Forward-looking number people are called finance people. And finance people are there to make decisions about how to allocate resources. And the reason why people don't understand or know about finance people is that there's no finance shop on the corner advertising to prepare your tax return. Right.
Mm.
We are all aware of accountants because accountants are everywhere. There's a lot of people that do accounting. Every business needs to do a tax return and eventually needs the help of an accountant to do the tax return. But not every small business is going to have the need for a finance professional in their business. And if you look at the largest companies out there, they've got whole floors of finance people. They're using the product of the accountants. They need to have accurate accounting data about the business in order to make their forward-looking decisions and projections and to help understand where capital or resources should be spent. But figuring out what a business is worth is part of that kind of evaluation of where we should put our capital. So it's very much a finance function. So in businesses, as they grow bigger, at some point, a business will eventually need a CFO, a chief financial officer. There are people now who are doing this on a fractional basis so that smaller companies can afford this skill set as well. But really, business evaluation is a function of finance rather than accounting. That isn't to say that there aren't accountants who have no idea what they're doing or anything like that. But some of the craziest evaluations I have seen have come from accountants. I've seen
Accountants, I would
people.
say, are transactional, whereas the financial people are project-based mindset.
Yeah, the accountants, I've seen, and so not to pick on accountants because there's a lot of great ones out there,
We
but I've
generally pick on
seen,
C-suite on the show, so
okay,
we'll just make it an
I,
accountants one today.
I've seen people, for example, mix different methodologies. I've seen people, they'll take a cash flow of a business, they'll multiply it by a certain number, and maybe that number is a low number and they don't think that it quite seems right. So then they'll adjust it by adding the working capital, multiple of cash flow plus working capital. Well, that's not a methodology. Or they'll add the fixed assets or something like this. One of the most extreme examples I saw was an accounting firm took the cash flow of a business, multiplied it by 3, said that this represented the goodwill, then added the operating capital position, and then added all the fixed assets. And they came up with a number that was 9.5 times the discretionary cash flow to the owner. And when I saw it, I basically said, look, this is the kind of valuation that a junior stock market publicly traded stock trades at. And you can't tell me that a small business has the same risk profile as a publicly traded company. That's my take a step back, look at the broader picture initial assessment when I see a lot of things like this is I'll say, what do they expect I'm going to pay and what do I get for my money? And what you get for your money is always the cash flow. And so as a buyer of a business, you always need to look at it from the point of view is what is my overall project cost and what is the cash flow I'm going to receive for doing that project. So a lot of the times businesses will be sold as share sales. People will buy the corporation, the entity, and that may be capitalized in a certain way. But there's another way to buy a business, which is an asset sale, where
We
you
might have
are
to come
literally.
back to that another time, David, I think.
Okay, all right, sorry.
As much as
But
I'd like to, but just want to say thank you so much for all that. That's just fantastic. We will put all
no
this
problem.
together and make sure that people have access to all of your resources as well. And just
Awesome.
something that we didn't get to touch is that David works in USA, Canada, Australia.